Bob Prechter, welcome. You're taking all the glee out of the month of May. Tell us, when is this rally going to end?
On the contrary, Pim, you and I talked on the February 25th. That was about 10 trading days before the low, and I said, we're getting out of the shorts. It's time for a rally. So we hope that people, enjoyed what has come since. We've had a 40% move up in the S&P. Nearly a 30% retracement of the decline from 2007. We've had a response in the commodities and a corresponding drop in the dollar. I think this is all part of the reflationary period that should last through the summer. And it's a good time for people to use the uptrend to their advantage, because I do, as you point out, think that once it's over, we'll have another leg down. But in the meantime, it's up for a while.
All right, Bob, in the meantime, what areas of the market are the best to prospect in if they want to take advantage of what you describe as a summer rally?
I don't know, because I don't work on individual stocks or sectors or groups. But I do think that all the same market theory kind of comes into play here. This is something that I developed in the Conquer the Crash book, and I said once you get into a net deflationary period, liquidity is the entire driver. So what you get is falling markets all at the same time. I'm sure you remember from July of 08 all the way to the bottom, we had commodities going down along with the stock market and real estate all together. Now you're getting a rebound in most of these things all together. So the key is, don't try to diversify thinking that's going to help you out. You need to be looking at market timing above everything right now, because all of these markets are coordinated and they're moving more or less together. Not necessarily day by day, they don't turn on exactly the same time, but roughly speaking, you can count on a recovery period when optimism is increasing. At the low, we were all the way down to 2% bulls. That's the lowest ever recorded in the S&P. That was on March the 9th. It's climbed back up to about 80–85% in the last few weeks. So we're getting there, but we think there's a little more to go.
Bob Prechter, talk about the U.S. dollar right now. Are you watching that for any indications of when this rally might falter?
Well, we've got a graph we might want to show if you have it handy, a chart of the U.S. dollar index. This shows the tremendous rise from March of 2008 into the peak in 2009 in March. It was a 12-month move, very, very strong. Again, it started out with most people extremely pessimistic on the dollar. There were only 6% bulls at the bottom in March of 08. Well, by the time we got into the two tops, when it was peaking, double topping, we had over 90% people optimistic on the dollar. And of course, now that it's been gone down, as we have been in this reflationary period and other assets have gone up, people are now worried about the dollar, and they're talking about a crisis again, and they're talking about bailing out. Well, they're only 13% of traders bullish. I don't think we're quite at the bottom of this dollar move, but we're getting very, very close. This is the kind of thing you want to see, people really getting worried. That usually means you're getting close. It was something like perhaps we saw in January of last year as we were getting closer and closer to the low in the stocks.
Where do you see those bullish signs?
The numbers I cited come from trade-futures.com. They've been keeping records for 22 years on all of these indicators. Now, this is just one that's easy to cite because they're daily and you can follow them quite easily. But it's a short-term measure. And when you're looking at the very long-term trends in the market, you have to look at much longer-term expressions of optimism or pessimism. For example, in 2007, actually from 2000 all the way to the double top in 2007, you had extremely low dividend yields in the Dow, as low as 1.4%. You had very high PE ratios and that sort of thing. So those have not improved, and that is part of my argument for why this is a bear market rally. We need to go down for a number of years after this rally is over to get those indicators at a normal bear market bottom type of level.
All right, we're going to continue the conversation more with market guru Bob Prechter. I am back with Bob Prechter, the man who called the 1987 stock market crash just 2 weeks before it occurred. He's also the publisher of the Elliott Wave Theorist, and he's bearish on U.S. equities, although not short-term. Now, you just heard from Ken Fisher. He says we're in the next bull market. What about his point, Bob, that the emerging markets are leading the way? Is this a long-term sign or just confirming your intermediate-term analysis?
Well, the degree of the rise that we were forecasting in late February was primary degree, and that just means, in our parlance, a pretty darn big rally. That also indicates a very strong turn toward optimism, and that's the kind of thing that gets business people to loosen up, creditors to loosen up, debtors to take on more debt. So you're seeing, essentially a reflationary recovery, and you're going to see it in the emerging markets. You're going to see it in the economy. I think you're going to see it politically, where people say, "Oh, look, the government's programs are working, and the popularity of the president will probably increase." This is all classic, and it could take anywhere from a few months to a year to do this partial recovery. But I think when it's over, the economists will be unanimous that the recession is over. People will say it's a new bull market. That was the major bottom. And for us, it's a very important bottom. That's why we got out of all the short sales and said, look, you can't do this anymore. It's going to be it's going to be a sharp rally. It'll be very strong, and people will be very optimistic by the end of it. I think by the time this is over, if we're talking again at the time this rally peaks, I think you're going to have a consensus saying exactly that this is a brand new bull market. But we see it very differently. If you want an analogy, I think you can look at the rally post-1929 crash that went from November 29 to April 1930. That was a very powerful recovery, retraced 50% of the drop. People said the worst is over, we're back in a bull market, and that was incorrect. But in the meantime, we have to let this thing play out and let these kinds of opinions come to the fore.
Another question for you, Robert Prechter, from a follower talking about oil and oil prices. Will peak oil have an effect on your outlook? Is there a deflationary effect having to do with oil right now?
Well, I think all the commodities reflected the deflation that occurred in 2008. They all basically collapsed between 50% and, in oil's case, 78%. But at the time, it was all the way down in the 30s, and I said, look, a normal retracement back up here would be about to $80. So we're at 65. There's more to go, probably, to bump up into that upper area. But we absolutely don't see new all-time highs. We see, and across the board, we're calling this a bear market rally. That isn't over yet, so there's a little bit more to go. What I'm hoping to do is maybe get together with you later on when we think all of these things are giving, serious top signals. We don't quite have that yet. We're getting later in the trend, and we're seeing all the evidence of that, but probably not yet the peak.
Robert Prechter, does it occur to you that there's a certain irony trying to time the market, that things really do take a lot longer than many market analysts expect? Things do not happen overnight, and that psychology, when it shifts rather slowly. Is that not correct?
The irony in the market is just pervasive. The market is all about irony and paradox, and it's fooling people all the time in countless ways, and all of these waves are occurring at all degrees. That means short-term waves that fool people, intermediate-term waves that fool people, and of course the biggest ones of all that fool the entire population just about. So your point is very well taken. It takes time to turn the barge around in the river. That's what's been going on here. But it was pretty much of a spike low. I mean, it's been virtually nonstop up now from the beginning of March. It's almost 3 months. So I think we're getting a normal bear market rally, but it's a big one. And so it's taking time, and we have to get used to this. And by the time people, I think a few more months go by, I think they'll be saying, oh, I get it. This is a new bull market. But you remember, on the day of the bottom, they weren't saying that.
Robert Prechter, you have even more followers. They want to know what you think about gold right now. Is gold a place to park your money if indeed you see this precipitous drop sometime in the future?
Gold is, you should have some gold because it's the only real money. I don't really feel that it's going to do what a lot of the enthusiasts are saying, and going to $3,000 an ounce or $10,000 an ounce, because I don't believe we're in an inflationary period. I think we have finally rolled over into deflation. Now, during this recovery period, though, everything is going up, and that includes gold and silver and oil and other commodities, along with the stock market. So, and even junk bonds have rallied. So you can tell that there is a return to optimism to some degree here. So all these things make sense in my view. It's always a good idea to have some real money. So I'm a gold bug at heart. I think that is real money. The dollar's not. But in the meantime, there are a lot of markets where you can be making money in dollar terms. That can be very, very lucrative. Being short on the way down, being long on this rally. There are great, great ways to make money that don't mean just sitting on cash, whatever form that is.
As someone that studied the markets for quite a while, what are some of the triggers that we should look for that market turning around and starting to become even more of a bear market?
The things that we look for are a completed wave count and a reasonable retracement, neither of which we've quite had. We also like to see extremes in optimism and people, really jumping on the bandwagon. Just like we showed in the dollar a minute ago, everybody loved it when it was selling at its highs, and now they don't like it. It's just a natural cycle. It'll never end. It's going on and on again. And here we are in a recovery period. And now people are saying, well, gee, maybe I should buy stocks. They didn't want to buy them down when the S&P was 667, but now that it's 900 something, they're thinking, well, gee, this is looking pretty good. That people have to learn to get out of that way of thinking that up, the farther up it goes, the more you should buy it. It's the other way around.
All right. Well, that's why we have you, Bob, is to help us make those kinds of intelligent decisions.